From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, credit concerns ease on Wall Street, with Goldman Sachs CEO David Solomon saying he does not see looming systemic risks. Traders repricing the odds of a December rate reduction. Fed Chair Jay Powell warns it's not a foregone conclusion after 2 straight cuts this fall. And this is in part because of a divided central bank. 2 dissents in opposite directions weighing on the Fed's path forward. We begin with that big issue, division inside the Fed.
Powell is losing his grip on the Fed.
Instead of a dual mandate, we have a dueling mandate.
They're threading a very fine needle between their 2 mandates.
There are strong signs here that Powell is struggling to manage the committee.
I think it's probably appropriate for there to be different views in the Fed.
There's more two-sided risks to the Fed's decision than the market was pricing in.
We did find the hawkish stance a little bit surprising.
I definitely think the rate cutting cycle is intact. It's just the speed at which they cut rates.
You have a pretty divided committee in terms of the case for preemptive cuts.
If things get worse, the Fed will respond and cut aggressively.
So I'm not sure where the gloom about the economy comes from.
The labor market is actually doing a little bit better than expected, and inflation is still at 3.
It is absolutely critical that they show their resolve to get inflation back to 2%.
We're in a bit of a data vacuum.
We will get a December rate cut, but nothing in 2026 or 2027.
And here's the tenor that is most sensitive to Fed policy. It's the 2-year, of course, and you can see that it started the week right around 3.5% and quickly spiked up as Jay Powell, the Fed chair, warned that a December rate cut is not a done deal. And just like that, the 2-year yield returning to its highest in almost 4 weeks. Now, you can see how pricing for a move in December also shifted immediately in the aftermath of the quarter-point cut on Wednesday. And we expect to see that, of course, but if traders were confident in another cut by year-end, you wouldn't see this line poking above that 25 basis points line, the dotted line here. The fact that it's above that shows that there's now room for doubt. And that move triggered by these words from Jay Powell.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. If you were to see data that suggested the labor market strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. We continue to face 2-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
All right, joining us now for our macro roundtable is Bryan Whalen, CIO and Generalist Portfolio Manager at TCW Fixed Income, and Subadra Rajappa. She is Head of Research at Societe Generale Americas. Bryan, let me start with you. Would you characterize this week's move as a hawkish cut?
No, I think the market's overreacted to this a little bit. I think, you got to remember, so Powell's in the room and he's got a bunch of governors, he's got regional presidents, some are voting, some non-voting, and you got 6 weeks to the next meeting. So I think, twofold. He came out and I think he kind of acknowledged the part of the audience, or the part of the people in the room about their concerns about inflation, or maybe they see the labor market differently than others. And I think he's acknowledging them, let them know they're being heard. And then at the same time, you got 6 weeks. And I think there's nothing wrong. Yesterday we talked about, I called it a brushback pitch, but basically, it's the Fed effectively helping the market just recalibrate just a little bit, the expectations. So there's nothing wrong with 6 weeks to go with not having 100% certainty that they're going to cut, and it's moved from 100% certainty effectively to something like 65%, which probably means they still do cut, but he's buying himself some optionality.
All right, so let me just follow up on that analogy. Does Powell follow up with a pitch where he tries to paint the outside corner, or does he throw straight down the middle? Meaning, did he get what he wanted in terms of resetting expectations?
I think so. Yeah, I think, look, you heard those comments. Not in there. He talked about actually later on in his conversation, he talked about that, if you exclude the tariff impacted prices, that, you know, the kind of the cyclical element to the economy, that inflation is getting close to the 2% level. And then he also acknowledged the softening of the labor market. You know, obviously we know we have a reduction in supply, but we've had an even bigger reduction in demand, which has led to some pretty soft, you know, hard employment data, which now obviously for the last 30 days we've been void of, although next week we'll get some private information from the ADP. But on the soft side, in terms of the anecdotal evidence, you hear things from Amazon and Walmart and UPS, and they're talking about cutting workforce. At the same time, we keep hearing about a reduction in the federal footprint. So more likely than not, over the next 6 weeks, you know, the soft data will confirm a labor market that's at best kind of trending flat and possibly even declining a bit, which should set the stage. And if he's right on tariffs and inflation, and we agree with him, for another cut in December.
Right.
And eventually those probabilities will go from 65% probably back up toward 100.
So, Subadra, how do you look for Fed officials to communicate their thinking on the economy in the interim before that December FOMC without the benefit of that official data?
So I'm hoping that the shutdown ends and then we do get official data. I think at this meeting, the Hawks and Powell wanted to have their voices heard. And, I think I agree with Bryan. Ultimately, when the dust settles, when we get the fullness of the data between now and the end of the year, it's very possible that we get another December rate cut. Our view is that the Fed, if they are trying to preemptively cut rates to ease the labor market conditions, they should kind of front load that and then kind of end after perhaps one more cut early next year. So, to us, it feels like the data is quite strong. The economy is in a good place. The momentum heading into the third quarter on the growth front is still relatively strong. And the labor market is deteriorating, but not as rapidly that warrants a lot of cuts. So it feels like the Fed is going to take it meeting by meeting based on the data that they have.
Sure.
And assess conditions before they progress.
It's a true debate inside the Federal Reserve. Raphael Bostic saying that he still thinks we're in restrictive territory. Beth Hammack just saying, I would have preferred to hold rates steady this week. And of course, we know there are two dissents in the decision on Wednesday. Subadra, economists say that dissents are the new normal now at the FOMC. What does that mean for bond yields to have that level of dissent when we've gone through this period where everything was pretty much unanimous?
I think dissents are healthy in this environment because we have, a situation where the risks are not really very clear, and we do have some outliers on both sides. So I think a healthy debate dissent is actually quite a good thing because you want to have all the voices heard. I mean, our personal view is that the economy is in a good place. Maybe the Fed shouldn't really be cutting rates aggressively in this environment. Financial conditions are still relatively easy. On the other hand, there are good arguments to be had in the fact that the labor market is weak, and you probably don't want to wait too long before you start easing. So I think dissents are actually a healthy part of the debate that's going on within the Fed.
Of course, the second part of what the Fed did, in addition to cutting rates and kind of keeping things open for December, is end QT, or at least announce the end of QT. Bryan, what does that mean for how you allocate for where you want to be on the curve?
With regards to the QT, that's all about liquidity in the marketplace. And the Fed, and clearly over the last 30 days, we've seen liquidity starting to dry up. You've seen some interesting action in these very short end yields, and the Fed's probably doing the right thing. They want to get ahead of the game. Last time in 2019, the Fed was late to the party. They extracted too much liquidity, and there was a tremendous amount of volatility. And this time around, they have more tools, and they're paying more attention. And so that's a good thing. So it really shouldn't impact yields when you got the 2-year up in the screen. That type of liquidity and the way they're going to manage it in a few basis points here and there really shouldn't matter and hit the 2-year yield. What would happen and what could impact the 2-year yield and the 5 and the 10 and the 30 and the entire yield curve is that if the Fed wasn't paying attention, drained too much liquidity from the system, it could lead to some capital market volatility. And that would more likely than not impact the longer end of the curve, most likely bringing yields down as the market gets really concerned about potentially credit contagion and liquidity issues.
Subadra, are you worried about that as a possibility, draining too much liquidity?
Yeah, and I think that, as Bryan pointed out, the Fed is getting ahead of the liquidity situation. You are seeing the take-up in the standing repo facility reach its highest level in the last couple of days. So definitely there are liquidity constraints in the system, and ending QT is the right strategy. I think what's going to be interesting is how the Treasury looks at its issuance going into the refunding meeting next week to adjust for this change in quantitative tightening from the Fed, because they might potentially think about issuing more bills, more front-end instruments, if there is another captive buyer for this particular sector of the yield curve.
All right, good stuff. Thank you both so much for joining us today. Bryan Whalen of TCW Fixed Income and Subadra Rajappa of Societe. Appreciate it. Coming up next on Real Yield, the auction block, Meta's massive bond sale driving high-grade sales to a record October. We're going to talk credit next. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we had a late surge for debt issuance to close out the week. Starting with high grade, the big one, of course, was Meta. The tech giant sold $30 billion of bonds, driving overall October sales to a record $132 billion. Other notable names this week included HSBC and Philip Morris. Let's dig in now into that Meta bond sale, because the company received a record $125 billion of orders, the biggest IG bond sale this year, and tied now for the 5th biggest ever, and comes even as equity investors express concern over Meta's pace of spending. Over in high yield, this is the part of the market that slowed down materially from the boom that we saw in September. We've seen $18 billion priced this month, the lightest for supply since April. Some of Wall Street's biggest voices throwing some cold water on emerging credit concerns. Take a listen.
A lot of the noise and drama around private credit is, somehow that there's a whole bunch of risk that's hidden in the system because it's no longer in the banking system, and that's going to present some systemic exposure. I don't see it. At some point, if the credit cycle turns down, they'll have losses.
Okay.
And those investors will have lower returns or negative returns. But that's business.
I don't see anything in the context of a handful of bad credit situations. It's leading me to say that we have a systemic issue around the corner.
Yeah.
Unfortunately, lenders make mistakes. There is fraud in markets, but we should not be fooled by the fact that this is a very robust credit environment. Credit spreads are tight, and when we do have a cycle, which probably will come when there's an economic slowdown, there will be losses, and we'll feel that across the economy.
All right, let's dig into all of this with our credit roundtable. Stephen O is Global Head of Credit and Fixed Income at Pinebridge Investments, and William Smith, Director of Credit at AllianceBernstein. So the fears we saw a few weeks ago have certainly dissipated, and we've now, it feels like, swung back to complacency with spreads snapping back. I want to start with Meta's jumbo bond offering. It's always interesting when the stock market and the credit market disagrees, right? The stock tumbled 11%, $200 billion of market value wiped out, while the debt offering received record orders. Stephen, how do you reconcile that?
And lack of correlation between how equity markets and debt markets react with respect to future growth prospects. I think you shouldn't draw too many conclusions by that one incident. There is a very strong appetite for credit right now. I think we are in an environment where credit should perform quite well in a low growth type environment. I think specifically with respect to Meta, you've got a situation where they're investing very heavily in CapEx, and that questions from an equity standpoint what that return on equity capital investment will be. But from a debt standpoint, there is very strong confidence in the ability to service that debt. So the two are different issues overall.
Different issues overall, according to Stephen. William, let's bring you in. Is there a different narrative driving the stock versus the bond?
I'm not so sure it's a different narrative. I think it's just a company that's dealing with a very large growth project where the returns on capital are unknown, and a great existing business that's massively cash flow generative. So for credit investors, when we look at that combination, that looks like a really good piece of collateral to lend against, and that's why you're seeing so much robust demand for the credit instrument. And I think equity investors are trying to put together what this means in terms of long-term growth and short-term CapEx spends.
Just a few weeks ago, we saw Oracle borrowing $18 billion in the investment-grade market, and banks are now preparing to launch a $38 billion debt sale to fund data centers tied to Oracle. But you also look at the cost to protect against an Oracle default rise. If you look at the credit default swaps, for instance, it has gone up. William, how do you read this? Is this some skepticism over the AI trade? Is this just normal hedging?
Listen, as credit investors, what we're really trying to establish constantly is what is the ability for that company to service debt long term. And when you have this big inflection point of unknown projects that require an immense amount of capital, credit investors rightly are demanding a bit more premium for their investment. That's healthy. That's disciplined. Investors are not going to necessarily believe with complete certainty that all of this CapEx spend in AI is capital that's really well spent, that you're going to earn a really strong return on that capital investment. So there's some question marks around that. We think that's healthy. The bigger trend for us is how much of this CapEx spend is going to sit on the balance sheets of investment-grade issuers that have really robust cash flow to service that debt versus how much of this is going to be done in a more speculative manner. And that to us is concerning. If you look at previous cycles, where we've run into big issues is when investors start to believe all the hype, they do not demand that premium, and they don't do their credit work.
So the unanswerable question at the moment is at what point the credit cycle really turns. And here's what Winnie Caesar told us. Take a listen.
I do think that over the next 12 months, there is that risk that some of these lofty expectations start to be a little bit disappointed. And that's where you start to introduce some of the conversations around what is the true fundamental trajectory of corporate credit. We've enjoyed a massive ratings upgrade cycle. Is that going to start to reverse and start to spook investors a little bit?
Stephen, let me bring this question to you. What is your take on what Winnie just said?
Well, I think credit cycles historically, as well as going forward, are correlated and in sync with economic cycles. And so the first questions around, are we facing a potential credit cycle in the future relates to what is your economic outlook? I would separate that from what you talked about earlier, which is the large growth in debt, particularly related to AI spending and adjacencies, creating some type of a potential future problem if the return on investment is not there. I don't necessarily think that's a problem, that's something down the road that I think will be a theme to monitor, and it does represent some potential risks to credit markets overall. But in the near term, I think you've got economic conditions where you're not really looking at any type of a material downturn in credit cycle. And that's been one of the pervasive themes since the last decade. Historically, every 5 to 7 years, you've had a credit cycle. What we've had since the great financial crisis is an environment where you've had a bunch of mini cycles, but we really have not had a full credit cycle. And I think there's a variety of different reasons for that. And even though there are some rising default rates that's taking place in credit markets, it's rising from ultra low levels to still moderate levels. So that's far from what we would characterize as a idiosyncratic or versus a systematic problem in credit markets going forward.
At the other end of the credit spectrum, when you look at high yield, the junkiest of junk bonds seem to have completely recovered from wobbles following the collapses of First Brands and Tricolor. If you look at this chart, the white line at the top is a CCC spread, and it is at the tightest since March, right around there at least. The bottom blue line is the high yield bond index overall. William, where in the credit market are investors pricing in any degree of risk? Where there are still signs of lingering concerns about borrowers' ability to repay debt, particularly if the economy starts to worsen?
We think there's actually a lot lost when looking at these high-level averages. There's actually a lot of discipline being shown under the hood. And we have moved into an environment, we think, that was really dominated by an euphoric type message from investors that were constantly searching and hunting for the most amount of yield, to one where investors are really looking for safe carry. And that to us is healthy. So underneath the hood there, when you look at CCC spreads, there's a growing percentage of the market that's trading at stress levels, and that's not really bouncing back. There are still significant concerns about the ability of those credits to survive and especially to survive given what looks like a slowing economic environment. And then there's a large portion of credit markets that investors feel really safe in, and that's leading to spreads being quite tight. But the other big element of this is that spreads are not the only thing that we're supposed to look at this cycle. The reality is that spreads are tight, but yields are still fairly elevated, and investors still really like the idea of adding significant income into portfolios. So what you're seeing is more of a investor change of behavior, of motivation, and what they're searching for, and they're really relying on what they deem as safe carry. So you're seeing double B spreads, as a great example, move to very tight levels, and also in single B space, but there's still some significant concern and discipline shown in the marketplace.
All right. Well, we got to leave it there. That's all the time we have for this, but obviously a debate to be continued. Stephen O of Pinebridge Investments and William Smith of AllianceBernstein, thank you both for partaking in this credit roundtable. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcasts on the Bloomberg Terminal and wherever you get your podcasts. Now, still ahead on Real Yield, we've got the final spread the week ahead with ADP employment data on deck. There is no government data, so we go to the private sources. This is Real Yield on Bloomberg. I'm Scarlet Fu. This is Bloomberg Real Yield. It is time now for the final spread. The week ahead coming up, OPEC and its allies meet on Sunday. Then we get a clock change here in the United States. On Monday, Fed Governor Lisa Cook making her first public remarks since the Supreme Court put arguments for her lawsuit on hold until January. Plus, we get earnings from Palantir. Let's move ahead to Tuesday. Big elections in New York City, New Jersey, and Virginia, followed by Wednesday, earnings from Qualcomm. We also get private sector jobs data from ADP, of course, because there is no government data. And more earnings, this time from McDonald's, Lucid, Robinhood, Elf Beauty, and AMC. Let's move ahead to Thursday, where Tesla shareholders will be holding their annual meeting and vote on Elon Musk's proposed $1 trillion pay package. Also, earnings from Warner Brothers Discovery, Moderna, and Sweetgreen. Then on Friday, University of Michigan consumer sentiment, yet another read. The New York Fed President John Williams will be speaking, and more earnings in the morning from Wendy's, KKR, and Constellation Energy. All right, time now for my final thought. The data point that we are going to get next week is on ADP employment data, and the consensus right now is for an increase of 27,000. That is after the prior month's read of a loss of 32,000. So a bit of a bounce back there for employment, at least according to ADP. That does it for us. Same time, same place. Check us out next week. This was Real Yield.